You know how grown-ups sometimes stress about money? There's actually a way to make your money work for you while you sleep. It's called investing, and if you understand it now, you'll be ahead of 90% of adults. Here's how it actually works. Imagine you have a piggy bank. Every week you drop in $5. That's saving. Good start. But here's the thing. That money just sits there. It doesn't grow. It doesn't multiply. It's basically taking a nap. Now imagine instead of a piggy bank, you have a magic garden. You plant seeds, water them, and over time they grow into trees that drop more seeds. Those seeds become more trees. Suddenly, your garden is expanding without you doing anything except showing up occasionally. That's investing. But let's get real for a second. What are you actually doing when you invest? You're buying tiny pieces of companies. Think about your favorite brands, the place that makes your sneakers, the company behind your favorite games, the store where your parents buy groceries. All of these are businesses, and businesses sell pieces of themselves to people like you. These pieces are called stocks. When you buy a stock, you become a part owner. If the company does well and makes money, your piece becomes more valuable. If lots of people want to buy that company's stock, the price goes up. You can sell your piece for more than you paid. That's how you make money. Sounds simple, right? Well, here's where it gets interesting. Let's say you buy one share of a company for $10. A year later, it's worth $12. You just made $2 without lifting a finger. But wait, there's more. Some companies pay you just for owning their stock. These payments are called dividends. It's like getting an allowance simply because you own a piece of the business. Now picture this happening with not just one company, but 10, or 50, or 100. Your money is working in multiple places at once, growing, earning, multiplying. You're sleeping. Your money isn't. But I know what you're thinking. What if the company does badly? Good question. Sometimes stock prices go down. The company might make a bad product. People might stop buying from them. A new competitor might show up. When that happens, your stock loses value. This is called risk, and it's why investing isn't the same as putting money in a piggy bank. Here's the secret though. Time fixes almost everything. Stock markets go up and down constantly. One day everything's green and happy. The next day it's red and scary. But if you zoom out and look at decades instead of days, something magical appears. The line goes up. Not every single day, not every month, but over 10 years, 20 years, 30 years, almost always up. This is why starting early matters so much. A dollar invested when you're young has decades to grow. That same dollar invested when you're old, it barely has time to stretch its legs. And this is where most people mess up completely. They wait. They think they need to understand everything first. They believe they need thousands of dollars to start. They convince themselves that investing is only for rich people in fancy suits who read boring newspapers. None of that's true. You can start investing with whatever you have, even $5. The important part isn't how much you begin with. It's that you begin. Because here's what nobody tells you about investing. The hardest part isn't picking the right stocks or timing the market perfectly. The hardest part is simply starting and then not stopping. Most people never take that first step. But you're different. You're still reading, which means you're actually curious about building something that lasts. So how do you actually start? What do you buy? Where does your money go? And how do you avoid making the mistakes that wipe out beginners? Let's start with the easiest path. Index funds. Think of an index fund as buying a tiny piece of hundreds of companies at once instead of betting everything on one horse. You're betting on the entire race. The most popular one tracks something called the S&P 500, which is just the 500 biggest companies in America. Apple, Microsoft, Amazon, all bundled together. When you buy into an index fund, you're not trying to pick winners. You're saying the whole economy will probably grow over time. And history proves you right. Now here's the beautiful part. You don't need a finance degree to do this. Apps like Robinhood, Fidelity, and Vanguard let you open accounts in minutes. Some don't even require minimum deposits. You link your bank account, transfer money, search for an index fund, and buy. That's it. You just became an investor. But timing trips people up constantly. They wait for the perfect moment. The dip, the crash, the opportunity. Meanwhile, years pass, and they're still waiting on the sidelines with their money doing absolutely nothing. Professional investors have a strategy that solves this. Dollar cost averaging. Fancy name, simple idea. Instead of dumping all your money in at once, you invest the same amount regularly. Every week, every month, whatever works. Some weeks the market's up and you buy less. Some weeks it's down and you buy more. Over time it averages out and you stop obsessing over whether today's the right day. Here's what actually happens when you do this consistently. Month 1, you invest $50. The market dips and you feel nervous. Month 2, another $50 at lower prices. You just bought more shares for the same money. Month 3, the market recovers. Your earlier purchases are already up. Month 12, you've invested $600 without even noticing because it became automatic. That's the real trick, making it so routine you forget you're doing it. Taxes will eventually matter, but there's a cheat code for that too. Retirement accounts like Roth IRAs let your investments grow without the government taking a cut every time you make money. You put money in after taxes, but everything it earns. Tax-free forever. There are contribution limits and rules, but for someone starting out, a Roth IRA is basically investing on easy mode. One more thing you need burned into your brain. Don't panic sell. Markets will drop. Sometimes by a little, sometimes by a terrifying amount. Your portfolio will turn red and you'll want to pull everything out to stop the bleeding. This is exactly when most people destroy their own future. Because here's what happens next. The market recovers. It always has. And the people who sold at the bottom, they locked in their losses permanently while everyone who stayed got their money back and then some. Starting small beats, starting never. $5 invested today begins working immediately. It compounds, grows, splits, multiplies. That 5 becomes 6, then 8, then 12. Not overnight, but it happens while you're living your life. Going to school, hanging out with friends, doing literally anything else. Your money doesn't need you to watch it. It just needs time. So here's what you do right now. Pick one investing app, open an account, and put in whatever amount doesn't hurt to lose. $10, $20, $50, doesn't matter. Buy an S&P 500 index fund. Set up automatic investments if you can. Then close the app and let time do what time does best. The investors who win aren't the smartest or the richest. They're simply the ones who started early and refused to stop. That's really it. No secret formulas, no insider tricks, no perfect moment you're waiting for. Just you deciding that your future matters enough to do something about it today. Most people will watch this, nod along, maybe even feel motivated for a few hours. Then they'll go back to scrolling, telling themselves they'll start next month, next year, when they have more money, when they understand it better. And decades later, they'll wish they hadn't waited. You've got something they didn't have: clarity. You know what investing actually is now. You know it's not gambling or getting lucky. It's planting seeds in that magic garden and giving them enough time to grow into something that actually matters. The companies you invest in will keep making products. People will keep buying them. The economy will keep expanding. And your tiny pieces of all of it will quietly grow in the background while you're busy living your life. 5 years from now, you'll either wish you had started today, or you'll be incredibly glad that you did. The difference between those two futures is one decision, one account. One small amount of money you're willing to let work for you, instead of just sitting there. Your older self is watching. Make them proud.